Hello to everyone and welcome to our today's webcast. How to manage financial risk to weather the current storm in the commodity trading industry. Many of us were thrown into the cold water some weeks ago with COVID-19, but also with the oil price shock. We had to learn being a home teacher and at the same time to work from home and to adapt to working remotely. This was not easy for all of us. And we are also facing challenging and unprecedented business challenges around the world. But when you're thrown into the cold water, it happens that you make at the beginning quite hectic moves. These might also be very uncoordinated. But once you have managed to stay above the water, you have to think strategically to stay above the water for a longer time and to adapt to the new situation and to get out of the situation even stronger. This is exactly what today's webcast is about. The speakers of today and me, we are very clear about what should be done by a company from a financial perspective to get out of this situation much stronger. My name is Martin Thomas. I'm heading the commodity trading and risk management team in Switzerland. I have with me today Pierre Gay from Sigbu Finance. Pierre has more than 20 years experience in the commodity finance sector and as a managing director at several international oil trading companies. Pierre's presentation will focus on trade finance and business-related aspects to prepare for the expected upcoming credit crunch. I have also with me Samir Sreikat. He is working in the commodity trading industry since 30 years in various finance positions. Currently, he's heading the trade finance operation team of Riverdale. Samir will provide some first-hand insights on measures related to the current crisis. And finally, I will provide some insights on how to best set up a finance and treasury function at the commodity trading group to make most efficient use of cash and liquidity, but also to have the most pragmatic and efficient IT setup to make this happen. Before we start with the presentations, allow me some housekeeping first. You will all be on mute during the presentation. During the presentation, you will see on the top right poll questions. We would like to invite you to answer to them and participate. The result of these questions will be sent to you with a follow-up mail to this webcast. You also have the chance to hand in questions during the presentation. They will also be on the top right. We will answer to them during the Q&A at the end. So, I hope you all have a hot coffee at hand, your kids are taken care of, and you are prepared to enjoy the next hour together with us. Therefore, I would like to hand over to Pierre, who will do the first presentation. Pierre, please, it's your turn.
Hello, everyone. My name is Pierre Gay from Sigbu Finance. I'm a 25-year experienced commodity financier, and I would like today to share with you experience in dealing with management of credit crunch from a trade finance perspective. I would like to start with a touch of humor. There's a liquidity definition that I like a lot, and you can see on that picture this nice couple over coffee looking obviously at an investment report. And the man looks at his wife and says, well, liquidity, that's when you look at your investments and wet your pants, which I find quite amusing considering the context. So our current crisis is mainly composed of a counter oil shock with extreme price volatility as we've seen these last weeks and days, with a flat price collapse as a result of simultaneous massive supply and demand distortion. The recent OPEC Plus agreement still needs to demonstrate long-term results, obviously, and an increased counterparty risk as a result of COVID-19 related actions by government. So all the above triggers extreme caution from lenders to finance new transactions exposed to market and credit risks. We are not in a business as usual era. There's a clear tightening of credit process by banks and funds alike, and that is a perfect recipe for credit crunch. So the current crisis specifically increases appearance of liquidity risk when banks are less eager to finance unsold positions or imperfectly hedged price risk. We should always remember that commodity finance for mid-sized trading companies is primarily under uncommitted credit facility, meaning that if a bank doesn't like the transaction you invite the bank to finance, they can just say, I'm sorry, I'm not going to finance it. Unlike the big boys, the major of the industry that benefit from committed trading facilities like revolving credit facilities. Then banks are reducing counterparty limits due to rating downgrading. Liquidity risk also happens when hedge margin calls are not financed entirely by banks. Whether you have a pre-hedge or spread or basis risk hedge, for example, that the bank doesn't either understand or doesn't want to actually finance or book under the TPA. It's a liquidity risk as well when a derivative broker reduces or cancels waivers on the non-tripartite facilities. So all the above results in an increased cash posting requirement ahead of new transaction finance and cash calls by banks and brokers to maintain a balanced position. Your standard 5 or 10% margin that you've hardly negotiated with your bank against your financing is part of the past today. Today, you're seeing requirement of 20, 30, even 50%. So the failure by traders to post such cash requirements clearly may trigger a reduction in finance availability and contract default renegotiation as a consequence. And in extreme cases, and I really stress extreme cases, you could be faced with voluntary closing of position by banks and by hedge brokers. So how to manage and mitigate this liquidity risk? Well, first, you should right-size the physical cargo and paper trading credit facility using stress test scenario, and that is driven by price and volume expectations. How much do you expect the volume you will put on your books next year and the year to go? What kind of price deck you expect to see on the commodity you trade? This is what is a stress test scenario all about. Then diversifying access to trade finance. More is always better than less. Same applies with derivatives broker. Again, the uncommitted nature of commodity finance implies a bank may stop financing a given risk while another would maintain the limit. So you mitigate a liquidity risk as well when you have a derivatives margin requirements financed under a TPA. But that requires explaining the hedge strategy and the monitoring of this risk to the bank. Then you should manage the target credit facility utilization ratio, ensuring sufficient financing availability. And here I always say 66% or 2/3 as a rule of thumb is required. Let's assume you have 4 banks and the target utilization ratio is 2/3 on each of these 4 banks. And the 4th bank decides to stop financing your business. Well, thank God you have the 3 banks where you only had 2/3 utilization ratio, so you can allocate the books financed by the 4th bank to the existing 3rd, 2nd, and 1st bank. But if you were actually using 100% of the credit facility for the 4th bank and the 4th bank still decides not to finance you anymore, you'll be, of course, exposed to a very significant risk. Then you should negotiate credit insurance policies with the same diversification concern. Negotiating new policies in crisis is mission impossible. You should determine equity and subordinated loans invested by the shareholders in function of the underlying commodity liquidity, the market, and the credit risk appetite required to generate value. You should negotiate factoring facilities to monetize receivables and reduce working capital financing requirements, and define and implement an IT trading system with position and liquidity management tools. Anticipation is key. All the above is to be determined and negotiated during sunny days, not under the storm. So what are the key takeaways from my reflection? Well, first of all, on the short term, as we all know, cash is king and cash must be protected. So the first thing you should focus on is to negotiate longer payment terms with your suppliers. Not easy, you would say, but there's a chance that they will agree in order to save the supply chain. Then you should reduce or stop deferred open account payments terms to client with counterparty risk deterioration as a guideline. Then you should identify and avoid cash burning transactions that are not vital. And always, and I repeat, always prioritize balance sheet integrity over P&L. Try to resist the once in a lifetime deal if it threatens the balance sheet integrity. Last but clearly not the least, call your banker, talk to him, inform him of how you manage the crisis and save cash. If your Q1 2020 financial statements are already ready, or even if they show an indication of your performance this first quarter, send it to him. Demonstrate you are on top of the situation. It will only generate goodwill. Then in the long term, you should always try to answer the question of what would happen if this or that risk element or materialization would actually occur. First, you should simulate stress test scenario and own business model sensitivity to liquidity risk. Then define the financing requirements and plan trade finance diversification, whether it's with banks and new funds added to the pool. And last but clearly not least, again, right sizing the credit lines and target conservative utilization ratio. Thank you very much.
Thank you, Pierre. These are great insights, and I'm looking forward to the questions during the Q&A. Now, Samir, we are excited to get your insights about how you are currently managing your company to get through these challenging times and what you want to make the audience aware of. Samir, please, it's your turn.
Thanks, Martin, for this introduction. So as just said, I'm Samir Zreikat, Head of Trade Finance and Operations at Riverdale Commodities SA. This is a medium-sized trading company. Our market is mainly coal and oil, with a focus on sales and deliveries to India or from the UK into the Amsterdam, Rotterdam area. So we are not dealing with soft commodities, and I will not be referring to anything related to soft commodities in this presentation. So again, the focus is on medium-sized trading companies, mainly companies focusing on niche markets where usually you have limited or captive clients, and your market segment is limited as well. The good thing as well is on one side is that you are not a threat to the larger trading house. So you try to keep and protect your business by having a long-term relationship with your service providers, with your suppliers and buyers. The thing as well that defines difference between medium-sized and larger trading houses is the decision-making process, which is quite often much faster than in larger corporations. But the fallback of that is obviously the equity and the access to cash, where quite often the trades you are doing are based on the scarce availabilities you have in terms of assets and cash. But quite often as well, you can trade faster, as I said, than other companies. In terms of trading, there are some restrictions. Medium-sized trading companies, usually we do not make a big long or big short plays. Speculation is limited, if not sometimes even avoided. And if hedging is required, it's a hedging which is under the control of the bank through what is called, as you probably know, the TPA or tripartite agreement. One of the disadvantages of being small as well is that you usually pay higher financial costs unless you are very strong in financing rates with your bank that are similar to those of larger companies that are opening lots of letters of credit. What happened recently? So what we've all seen is obviously the crude oil prices collapsing after the Saudis made their declaration. But more importantly, that was this COVID-19, which is seen as a black swan event, meaning unpredictable, with severe consequences, mainly on the collapse of the demand and various force majeure situation, if not declaration. And on top of that, adding disruptions to all business segments and processes. So from our perspective at Riverdale, we could start feeling the real impact in March this year. It started earlier in China, but for us, we really started to feel the heat, I would say, by mid-March, end of March. We had to adapt to changes, and most of us, and you probably as well, had to work remotely. In terms of the disruptions related to the commodity trading, first of all, as I said before, we could see a sharp decline in demand. The goods and the commodities that we are trading, mainly, as I said before, coal and oil, are used by the end receivers to produce power, but to make as well refined products or to produce steel. So as the demand globally started to decline, the possibility to find buyers became as well quite difficult as well. LIBOR rates as well declined, but we could see as well strong disruptions in the import and export through ports. We also faced some problems with some goods that we wanted to lift by train from the mine to the port and from the port then to the final destination. That was also a big hit for us as well. But as we didn't take financial risk before the ban started, we were not impacted by that. In terms of working process and banking activities, we could see as well some delays in obtaining SWIFT, in having the letters of credit open in time, and to negotiate documents as well, because courier services were sometimes stopped. And if your payment was made against presentation of an invoice and the original shipping documents, and you didn't have any payment against letter of indemnity, then you could start facing problems. The counterparties as well started having a totally different approach. And one probably of the biggest risk that we could see was indeed the potential counterparty risk. Why? Obviously, if prices are collapsing and you just bought a cargo at a high price, any way out could be seen for you as something very tempting. And on the opposite side, if you're a seller, you're doing your best to make sure that you're not losing your buyer at the price where you could make still acceptable profit, I would say. So in moving markets, in volatile markets, what is an advantage for one is obviously a disadvantage for the other. But if we talk about the first and immediate risk for the traders, we personally could see two different type of risk. First of all, if your business is about prepaying cargoes based on a provisional price, and by the time the goods are delivered, the market went down, obviously you may have overpaid your supplier. So is it a reliable supplier? Is the contract allowing you to get additional cargoes? Do you want to have additional cargoes to cover the difference in values, or do you want to have your money back? That's also something which depends on your own contract terms. If on the other side you were selling at fixed price, then is your sale secure? Could your buyer declare force majeure? But then what would be the consequences of this force majeure? Is it leading to damages, or is it a termination of the contract obligations? And could that stop or delay the payment as well? This is probably something that some of you have already experienced very recently. And last but not least, a force majeure FM, as written there, declaration. There is a big difference between a force majeure declaration leading to the possibility or the prevention of claiming for damages, or a force majeure which clearly ends the contractual obligation. One of the elements you should not forget, if you are the charter of a ship and you sold on CFR or CIF basis, then the risk passes to the buyer at the loading port. So your buyer could very well use the force majeure to say, I'm not going to pay any demurrage charge if you arrive with the ship now. But he couldn't say that he rejects the cargo. Again, difficult to discuss about all the different possibilities. Everything depends on your trading strategy. The impact on trade finance is there's a positive side and a negative side as well. The positive side is that the credit lines are set in dollars and not in tons or barrels, meaning that if the prices are collapsing, obviously in theory you could trade larger volumes. The other positive point is that LIBOR went down, meaning that your cost of financing is probably going down as well. But obviously, if the demand has collapsed, then can you do more volumes? Probably not. In terms of possible duration of your trade cycles, the tenors, if you start facing payment delays, meaning the tenor cannot be met anymore, will you be paying penalties, and will you be able to rebuild these penalties to your counterparties? That's also something that depends on how you set up your contract. And in terms of your banking trading relationship, obviously it is very important in this difficult time to keep a very tight and open and accurate relationship with your bank. They need to have information. They need to see that you are able to control your risk, that you know precisely where you stand, what are the potential losses you might be facing, because a bank and trading company's relationship is something which is set for the long term. So in order to keep this long-term relationship, it is very important as well to be sure that the communication with your bank is done. One of my last slides, how can you take proactive measures? Well, anticipate risk, know your customers, service providers, do not focus on short-term trades. It is better to have term contracts where you have, for instance, captive clients, or they know that they can rely on you even during difficult times. And something which I've always been focusing on is always analyzing my purchase contract versus my sales contract. I will always try to optimize the terms and conditions, making sure that the combination of both is optimal for me. And what always counts is to realize your profit. So what you should definitely focus on and put all your efforts on payment terms. How do you secure your sales proceed? As I mentioned before, if you charter ships, watch the force majeure clause that you have in your charter party versus what you have in your purchase and sales contract. And another very important element is, are you on top of your data? Do you know your exposure, your price risk? How much is payable in the coming days or weeks? Do you have sufficient cash for the next trades that you want your bank to finance? And what would be the impact on possible delays in the payment? And are the damages manageable? Can you make sure that your cash is sufficient to go above those potential losses? And last, very important element of, I would say, proactive measures is your internal organization and communication solid and appropriate? A last slide, which is related to cash margin and forecasting. Obviously, cash is the center of everything for small and medium trading companies. Without cash and equity, you cannot finance your cargoes. And it is important that when you have several banks or several credit facilities as well, or sublimits, you know precisely, based on a forecast of your existing and coming trades, how much cash will be required for you to continue your activities. And as most of you probably know, obviously, in order to have your cash returned to you, you need to have your buyer paying for the cargo. So doing the forecasting of your different credit facilities, how accurate your data is, and how you can consolidate all of them is very important. And if you start facing payment delays, my strong advice would be to immediately communicate this to your bank so that you can adapt your credit facilities with your bank. That's it for now. Thank you very much for your attention. And I guess there will be some question and answers now. Thank you.
Thank you, Samir. That were great insights. As you mentioned earlier, we are not in a business as usual situation. It is clear that traders of different sizes facing different challenges. Some have too much cash and liquidity available due to the low oil prices. Others might have liquidity problems due to margin calls, demurrage, distressed cargoes, or other cost-intensive operational or logistical expenses that occur now in the next months due to the global lockdown. Or they just face that uncommitted facilities are withdrawn or the company got downgraded, as Pierre mentioned. So the pain of trading companies are different. However, if it comes to a most effective cash and liquidity management, the solutions are more or less the same for all companies. Maybe let us have a brief look into the corporate world. What is the standard there? It is quite common standard to have global multi-currency cash pools in place. It is also standard to use specialized systems to have everything automated. Corporates apply plug-and-play solutions and digital platforms to a degree that even allows them to treat bank services or bank relationships themselves as a commodity, or even get banks out of certain activities as intermediaries. Another example is that corporates are getting used to apply virtual accounts to such an extent that local entities of the group do not have any bank account anymore. It is all done on a group level via an on-behalf structure. So coming back to the commodity traders, many of them are not there yet. On the other hand, it is true that for commodity traders, the bank relationship are more sensitive than for a corporate. That's completely true. However, there's plenty of room for improvement, which is a positive flip side to stabilize the financial situation and to cut costs. And in times where cash is king, the Treasury or Trade Finance Department is queen. Let me show you now what is relevant to be a good queen. everything starts with the cash visibility. Once you know where your cash is, you want to free up and concentrate your cash for the most efficient use. Then you want to forecast your cash and liquidity most accurate. And finally, you want to have all this automated via a push on a button. Let's first dig deeper into cash visibility. The goal is to achieve maximum transparency. That is the basis to decide if you need to draw cash, to sweep cash, or to invest cash. This is only possible if you are able to get all bank account statements into a system. You want to have this process automated, so no manual intervention. This is easy to achieve and quite common. And it gets much easier the less bank relationships you have for your cash management. The number of bank accounts is not so much a pain point here. It is really the number of different bank relationships that you have. That is something you should consider to improve. Usually this is done via bank RFPs. Let us briefly stick to the bank relationships, meaning core bank strategy. What does this mean? This is a quite delicate topic because banks are one of the most important suppliers for the commodity traders. However, it is very beneficial for you to have full transparency about your wallet with the bank. The wallet means all the business you do with one specific bank, but also how much the bank earns with that, with the business with you. May it be cash management, hedging, or the trade finance business. The cash management, but also the hedging business is very attractive for the banks because they do not need so much capital to do this business with you. So they are keen to get that. If you have this transparency, you are in a much better position to negotiate with the banks and to keep this relationship and negotiate really fair prices for both parties. So please use this on your side, this wallet approach strategically to allocate your wallet to your core banks. And at the end, the last bullet, if you have simple cash management system in place or treasury management system, it's just a matter of weeks to have a full daily cash visibility per push on a button. Next is the cash concentration. Once you have the visibility, you want to concentrate your cash. Why? Because you can reduce your funding cost significantly. You first use your global cash instead of external funding. That reduces the cost base. And by applying automated cash pooling solutions provided by the banks, you reduce significantly your internal manual processes to sweep cash between entities. This is mainly for your short-term funding. You can achieve a global pooling by applying different techniques and solutions such as notional pooling or zero balancing. In some regions, there are restrictions to move cash, but there are solutions for that. And ultimately, you can achieve a very high degree of concentration and to use the cash most efficiently. This relates to the next point, to free up funds from restricted countries by accessing trapped cash. The pooling techniques provided by the banks help you with that. However, in times of crisis, it is important to monitor carefully, and that's the last bullet, how group entities draw funds out of the group cash pool. You should have limits and alerts in place to manage any risk and protect the group from difficulties in local entities. That is something you need to be very aware of right now. Let's go to the next topic, cash forecasting. The goal of cash forecasting is to secure financial stability and to reduce the need for external funding. There are different forecasts in the group that often have different numbers. It is usually difficult to explain the deviations between the different forecasts. Also, quite often the forecasts do not match the actuals. If you have a backtesting and clients are struggling to explain where this deviation comes from. These are quite typical problems. Especially in these times where the liquidity is tight, it is most important to have clean and reliable data and forecasts because these numbers and data will be very relevant for the board meetings because they have to investigate what is the risk for our company. However, this is unfortunately nothing that you can improve quickly. That's not a short-term solution. This needs a proper analysis to identify cash flow drivers throughout the group. Typically, reasons for deviations are lack of data harmonization or legacy methods that are still applied and not aligned between the whole group. So there are plenty of reasons why the forecasts are not accurate, and it costs your company a lot of money. In these times, it's critical, and certainly on the CFO and even the CEO radar, the forecasts are not accurate. And so my recommendation is that once the firefighting is done, you have stabilized the business, you should improve these processes as long as this topic is still on the radar of the management. It is also no rocket science anymore to use predictive analytics. There are a lot of use cases out in the market to improve the accuracy of the forecast with internal and external data. And there are also plenty digital solutions, even in the treasury system or cash management system, which you can apply, or you can build it on your own with Power BI or Tableau or any other BI solutions. Next topic, the IT ecosystem. What I see quite often is that clients try to get all solutions into one system. This always results in high costs, long-lasting project, and a lot of frustration. Either all solutions shall be in the ERP, or clients try to put all solutions in the commodity trading, so the CTM system. What I also see quite often these days is that a lot of companies spending a lot of money to develop their own IT solutions. These are also quite long-lasting projects for solutions which are already out there in the market. And I have to say, I think to put all solutions into one system, this one system fits all approach, is a cost-intense mistake. You should use the systems for what they are built for. The ERP system should be used for all accounting matters, the commodity trading and risk management system for the trading-related topics and risk management, and specialized treasury systems for the cash management and payment topics. In best case, you add also digital platforms, for example, for competitive pricing, for working capital optimization, for e-invoicing and discounting and matching, or to use smart BI solutions such as Power BI or Tableau for all the reporting topics. However, when I talk to my clients about an ecosystem, the argument is always that with an ecosystem, you have a lot of interfaces and not harmonized data. No question, that is a challenge that has to be tackled, but it can be solved. And it's much simpler to solve this problem than programming a CTM system into being an accounting system or being a cash management or even a payment solution. So the specialized systems out on the market are not expensive, not at all. They're easy to implement. Very often there's software as a service solution, so the maintenance is quite low. You benefit from the improvements done for all the clients. You will have access to them automatically. And it's also important that they are easy to replace if there are better solutions available in the market. So this field is quite dynamic. And you do not have this flexibility in a one system fits all approach. That's why the ecosystem, in my point of view, is much smarter. In the short term, you should do the following. You should get a daily cash visibility, ideally fully automated. Second, you should restructure your global bank relationship and even think about a core banking strategy. Third, you should use the volatilizing approach for your negotiations to achieve fair prices. And fourth, you should concentrate cash globally by using the bank solutions for cash pooling. In the midterm, you should seek to improve your cash forecasting accuracy and any deviations you might have to other planning data. And you should even think about it, to apply predictive forecasting solutions to improve your accuracy of forecasting again. And last but not least, you should build an ecosystem of specialized plug-and-play solutions because this is most cost-effective. You use the system, what they were built for, and you are highly flexible to use the latest technology. So thanks a lot. This was the part of my presentation. Now we are open for all the questions you might have, and let's jump into the Q&A session. I will check now with my colleagues which questions we got in from you.
Yes, hello again. So I see we have a question regarding, the question precisely looks at what leverage has a trader in case of payment delays or non-payment. That's a very interesting question in the current circumstances. And if you could allow me, I would like to perhaps contextualize that question a bit. Obviously, if there are payment delays or even non-payment in the current circumstances, you first have to ask your question, about the reason of such delays. We've just experienced a collapse of the flat price of many commodities and definitely in the energy and oil sector. So if the reason for non-payment or delay in payment is because your counterparty is just going belly up, is just bankrupt or is just incapable of paying you, I would say that's situation A, which obviously you would have to understand whether you already supplied the commodity and you don't actually control the commodity anymore and it's being digested by your client. In that case, well, maybe you're just about to become a creditor amongst others, and unless you have a credit insurance, then that's going to be a tough situation to be faced with. But if the reason for the delay is because your customer, which is a going concern customer, it is willing and able to pay, but basically, he has a huge business case to handle. So if your customer, for example, has purchased from you before the collapse of the oil price, let's say diesel at, say something, $600 a ton, and you've supplied the diesel, you've invoiced it, and between the moment you invoiced and the moment he's supposed to pay, then comes the collapse, and the price of diesel has been divided by 2. Then you understand that he is faced with a situation that he could actually go to the market, or his own customers could go to the market and buy diesel at half the price. But let's assume this is a client that is a long-established client of yours, and for example, he's a retailer or a wholesaler. So you might be willing to help him out by going to your bank and saying, okay, this is my client. He's a credit-worthy customer. He has access to credit facilities, etc. But we would like to help him out by giving him a bit of delay, to swallow the price collapse. And perhaps I would even consider to supplying him more diesel at the current price, so that the customer could actually be averaging the price before the crisis, $600 in our example, with a current price of $300. And if everybody is behaving, properly, and there is solid ground in terms of the credit worthiness of all parties involved, then you may want to go to your banker and say, okay, give me 1, 2, 3 months, 4 months, X month, to actually dissolve and digest, averaging the various purchase prices. And then, at the end of this period, we'll all be safe and alive and kicking. And then, everybody will have a great future. So this will be my answer. First, why, there is a delay. And if the delay is justified because of the price collapse, and you have in front of you a client that has, demonstrated in the past that it has a strong, business model on its own, maybe this is what you want to do. Averaging, giving a bit of delay, financing new purchases at a current market price. So that's what I would recommend. So thank you very much for the question. Very good question.
Okay, what are the most important mitigation measures that should be taken by trading companies within the next 3 months? I see different axes to answer that question. First of all, it would be to know precisely where you stand in terms of what is the current situation in terms of how much money is outside, meaning how many clients haven't paid their cargoes or their fees or whatever it might be. How much you are supposed to pay as well in the coming days and weeks. So an accounts payables and accounts receivable plan that is as accurate as possible. This means as well that your data management system is efficient, that the information is fed on time with the latest and up-to-date information. So again, using the example of a pilot, he needs to have instruments that tell him precisely where he is and what is ahead and how much fuel he has for the continuation of the journey. The second layer or axis would be to set priorities. In order to set priorities, you need to identify the different risks you are currently exposed to. And for each of these risks, to find possible mitigation measures. So quite often you might need the assistance of legal firm, but before everything, I would say that the expertise within the trading house is important. Do you have sufficient expertise to properly assess these risks and see how, as well how this risk could evolve in the days to come? So the chronology of events, the typology of risk is something very important. What I would also say is, as trading is about signing contracts and committing to these terms and conditions, and if you don't, then facing possible litigation measures, claims, and so on and so forth, it would be to do a very thorough, precise analysis of your contract terms and conditions, and always comparing the purchase versus the sales for a given trade. Is what you're buying protecting you from what you're supposed to deliver and sell? Do the timing periods match? Are the payment terms in your favor? And if you are a charterer, meaning if you sign charter parties, are there clauses that are aligned with what you have in the purchase or in the sale contract? This is very important. And last but not least, what is your cash position? How much cash do you have currently available? And based on the forecast I was talking about before, is the forecast of your cash needs and cash releases sufficient for you to continue your activities? So these are the main axes that I'm thinking about right now.
Thank you both, Pierre and Samir. I also like to answer one question which I received. The question is, how long does it take to develop a new core banking strategy and cash management approach? Yeah, to answer this question, I have to differentiate. Yeah. So if you have global banks already in place and you decide to use a simple cash management system, a plug and play as software as a service based system, you have the system and the connectivity to the banks implemented within 2 months. That's an average, I would say. Of course, it takes a little bit more time if you combine this with a bank RFP, which I would recommend. A bank RFP is very beneficial if you want to define a new core bank strategy. Doing a bank RFP does not mean necessarily that you have to select new banks. But as a result, you will get rid of a couple of local banks where you have cash management, payments, or any other transactions with, or maybe you have them for legacy reasons, for whatever reasons, but you will get rid of them and you will allocate this business to your main financing banks if they provide similar services in this country. You will see that usually very easily by an RFP. Yeah. So in this process, you will talk to your banks. That's the benefit of this, even if you don't change them. And you can use strategically that you give them the cash management or any other ancillary business. It's like a trigger to renegotiate your prices with them for any business you do, yeah, or even extend the credit lines or whatever it is that you want to achieve. Yeah. So, and then once you have a renegotiated core banking strategy or a confirmed core banking strategy, but with new prices, then you can start building the connectivity and the new cash pool solutions. Yeah, because this should also be a part of this. Setting up a new global cash pool if you're not already advanced, because it provides so much advantages. And once you have this in place, this, let's say, centralized connectivity to the banks, a reduced bank relationship, reduced to your core banks, then you are able to improve much more processes with different time frames. For example, as a very natural next step is to send all payment files through this one platform, which you already use to collect bank statements. This allows you to shut down all the local e-banking solutions, which is quite an advantage. Yeah? So routing through all payment files to one local or centralized solutions, that's the advantage. You will also be able to automate the bank reconciliation process, or you will be able to start using on behalf structures if you have this platform for the whole group available. All that are very natural steps once you have a core banking strategy and the platform to communicate on the group level with these banks in the most automated manner. Of course, the duration of these projects is then different, right? It's not a 2-month project anymore if you go these further steps. And as a thumb rule, the more banks you have to change, because there might be banks providing you much better services or prices, then the longer the project takes because of the, you know it, the painful KYC processes. Yeah, this was the answer to this question. I'm now looking to my colleagues and we are running a little bit out of time. So let me wrap up and finish this today's webcast. You will receive the results of the polls today, where you have answered to, and the answers to the questions we were not able to answer now. You will receive all these as a follow-up mail. Yeah, so we'll get all this information afterwards. Last but not least, I only have to thank you now for participating. I hope and I'm certain that some of the information today are helpful to navigate your company through these difficult times. Yeah? So if you have any questions or comments to what we discussed today, please do not hesitate to come back to Pierre, Samir, or me. We're happy to discuss and enter into a fruitful discussion. Again, thank you very much. Stay safe and speak to you soon. Have a nice day.